Imagine a company whose value is soaring into the billions, yet its actual revenue is almost non-existent. How does that even work?
Right. It's a head scratcher.
And more importantly, is it a brilliant bet on the future? Or, a massive speculative bubble just waiting to pop? We'll actually unveil an intrinsic value range later that, well, it might shock you.
Stick around for that.
Welcome, curious learners, to the Deep Dive. Today, we're plunging into Quantum Computing Inc., ticker symbol QUBT.
QUBT.
Exactly. We've got a fresh research analysis hot off the press from July 30, 2025 to help us uncover the most important insights about this. Well, this fascinating photonics pioneer.
Pioneer is a good word for it. Very early stage.
Our mission today is to cut through all the noise, all the hype, and give you a clear, actionable understanding of what's truly happening with QUBT.
Yeah, separate the signal from the noise.
And here's why this is incredibly relevant right now. QUBT's Q2 2025 earnings report is expected pretty soon, between August 11 and August 20, 2025.
Coming right up.
And just a heads up, our partners at Stock Analytics AI will be covering these earnings within minutes of their release. So make sure you stay tuned to their channel for that immediate analysis.
Definitely worth watching.
Okay, so today's deep dive will unfold in two main parts. We're looking at 7 key chapters. First, we'll tackle the core, business, management, and the financials. The foundation.
Or fundamentals, such as they are.
Right. Then we'll move into market sentiment, ownership, risks, and finally bring it all together in a conclusion.
What's really fascinating here, I think, is that QUBT isn't just a tech story. It's also this profound study in market psychology versus, well, fundamental value.
Psychology versus the numbers.
Exactly. We'll be connecting those dots for you, helping you see not just what the numbers say, but why they truly matter in the bigger picture.
Okay, let's do it. Let's kick off part 1. Understanding the foundation. Chapter 1. Business analysis. Okay, let's unpack this. Quantum Computing Inc. QUBT. It's not just a pure-play quantum computer maker, which I think many people might assume.
All right, that's a common misconception.
What's really interesting here is their dual-pronged approach. Their long-term ambition is certainly to be a full-stack quantum solutions provider. Yeah.
Absolutely. That's the big vision.
But also, importantly, they want to be a commercial manufacturer of advanced optical chips, photonic integrated circuits, or PICs.
And that's the key part of their de-risking strategy, as they call it.
De-risking. Explain that a bit.
Well, basically, they're using the more immediate market for these PICs, a market that already exists and is growing to, generate revenue and fund their bigger, much longer-term quantum ambitions.
Got it. So revenue streams.
They are generating some revenue from product sales. Things like their Dirac series, quantum computers, the EMU core reservoir computers, which are more for AI tasks, and various sensing and cybersecurity devices.
Okay.
But the crucial new stream, and where a lot of the market's attention seems to be focused right now, is their foundry services, manufacturing these PICs for others.
Right, the foundry. That seems key.
That's their immediate play, really, designed to bring in cash flow while the quantum side matures, which could take a while.
Okay, now this next point. This is where it gets really interesting, I think. Their big technological differentiator.
The secret sauce, potentially?
Yeah. Their products like the Dirac 3 entropy quantum computer, EMU core for AI, LiDAR, single photon imaging, UQRNG for cybersecurity, and these thin film lithium niobate TFLN chips from their new foundry in Tempe, Arizona.
That's a mouthful.
It is. But the key thing is, they can all operate at room temperature.
Room temperature, that's the headline.
Think about what that means for cost and practicality. Compared to competitors who need these complex, expensive cryogenic cooling systems. Yeah. Massive potential advantage, right?
It's huge potential. It could dramatically lower the barrier to entry and the operating costs.
Then here's the but. If it's such a massive advantage, why isn't the revenue pouring in yet? What are the practical hurdles?
That's the critical question, isn't it? Despite that potential, we need to be really clear. QUBT is extremely early stage, essentially pre-commercial.
Pre-commercial. So, ideas, mostly.
Well, they have products, but the scale, it's tiny. We're talking just 50 employees. And they're trailing 12-month revenue, around $385,000.
$385,000.
Yeah. Compare that to its market capitalization, which is floating between, $2.28 billion and $2.43 billion?
Billion with a B.
Billion with a B. This massive disconnect between current operations and market valuation, that's the absolute core of understanding this investment thesis. Or lack thereof, depending on your view.
Okay. So, for you, the listener, the user, what does all this mean? QUBT's main value proposition seems to be making quantum tech accessible and affordable.
Democratizing it, essentially.
Right, designing user-friendly systems like their Catalyst platform that you don't need a team of PhDs to operate. That removes huge barriers to adoption if they can pull it off.
And if we connect this to the bigger picture, QUBT sits right at the intersection of two high-growth markets. First, the global quantum computing market. It's projected to grow from about $1.8 billion this year, 2025, to maybe $7 billion by 2030. That's a compound annual growth rate over 30%. Huge growth, fueled by massive government investments, like the U.S. National Quantum Initiative.
Billions pouring in.
Exactly. And then separately, you have the PICs market, the photonic integrated circuits. That's already about $15.4 billion in 2024, set to grow to maybe $38.4 billion by 2029.
Also huge growth.
So this dual exposure, playing in both quantum and photonics, is a really key part of their strategy. Diversification, maybe?
But the competition. Wow. It's fierce, isn't it?
Oh, absolutely. You have the pure play quantum companies like IonQ, Rigetti, D-Wave. Each has their own tech, their own approach.
Yeah. The giants.
Then there are the absolute giants. IBM, Google, Microsoft. They have practically unlimited R&D budgets, decades of research in some cases.
That's not all?
Nope. Plus, you've got established photonics players already active in that PIC's market, like Cisco and Marvell. They know manufacturing. They have relationships. It's a tough crowd.
So this brings up regulation, right?
It does, and it's kind of a double-edged sword. On one hand, all that government support is a huge tailwind for the industry, funding R&D, pushing adoption.
Good news.
But on the other hand, you have geopolitical tensions. That means things like export controls, tariffs on quantum tech, and critical components. That could definitely increase QUBT's costs and potentially hinder their global supply chain.
Making affordable harder to achieve.
Precisely.
And it's not easy just getting into this game, is it? The barriers to entry seem incredibly high.
Extremely high. First, you need massive capital investment, just huge amounts of money for R&D and facilities.
Right.
Then there's the talent scarcity. It's real. McKinsey actually predicted that fewer than half the quantum jobs needed would be filled by 2025. Finding the right people is tough.
Wow.
And then you have the immense technological hurdles, like achieving robust quantum error correction.
Error correction. Explain that quickly for listeners.
Sure. Today's quantum computers are often called NISQ devices, noisy intermediate-scale quantum. Noisy means they're prone to errors from environmental interference. Fixing those errors reliably, making the computation fault-tolerant, is probably the biggest challenge facing the entire field right now.
Okay, huge challenge. So competitive advantages for QUBT. Where do they stand? Brand strength.
Well, brand strength is interesting. QUBT has significant name recognition, often, frankly, as a meme stock among retail investors.
Reddit crowd.
Yeah, that kind of buzz, which can be good for raising capital, getting attention. But within scientific circles, their credibility is still pretty nascent compared to the IBMs and Googles of the world.
Okay. Cost advantages, that room temperature tech.
It could be cheaper, yes. That's the promise. But it's completely unproven at scale. Can they manufacture reliably and cost-effectively in volume? We don't know yet.
Network effects.
Currently negligible. But their Catalyst software platform, if it becomes widely adopted, if it becomes an industry standard for accessing different quantum hardware, then it could create a protective moat. Lots of ifs.
Lots of ifs. But what about something more concrete? Is there a more defensible advantage right now?
Yes, I think there is. Probably their most significant, most defensible advantage right now is that in-house thin-film lithium niobate TFLN photonic chip foundry in Arizona.
The foundry again. Why is that so important?
Because this vertical integration does a couple of things. It potentially insulates them from some supply chain risks, gives them control over a key component, and crucially, it provides a tangible picks and shovels business.
Picks and shovels. Like selling tools during a gold rush.
Exactly. It can generate revenue independently of the long, uncertain quantum timeline. It's a strategic hedge. It allows them to fund their quantum lottery ticket, essentially.
So it almost feels like two companies bundled into one, doesn't it? The steady manufacturing hopeful and the high-risk, high-reward quantum moonshot.
That's a very good way to think about it.
Okay, let's move on. Chapter 2. Management evaluation. All right, Chapter 2. Who's steering this ship? This is crucial, especially for an early-stage company.
Absolutely. Leadership matters immensely here.
So there was a recent change. Dr. William McGann retired as CEO in May 2025. He was there about 15 months.
Relatively short tenure.
Yeah. But the good news, perhaps, is who succeeded him? Dr. Yuping Huang. He was already the company's chairman and chief quantum officer.
And critically.
And crucially, he was the original founder of QPhoton. That's a company QUBT acquired back in 2022 to really build out its hardware strategy.
Right. So the technical visionary is now in charge.
What do we know about Dr. Huang?
Well, he's a deep technical expert. We're talking over 20 years of quantum research experience. He's secured over $40 million in government research funding over his career. This appointment really signals a powerful commitment to a product and R&D-led culture.
Which makes sense for a deep tech company.
It's logical. It should inspire some confidence, at least from a technical direction standpoint.
How about communication? Transparency.
QUBT has, the standard public company communications, SEC filings, investor relations website, conference calls.
The usual stuff.
The usual stuff. However, there was that recent profit they reported. We need to talk about that.
Yeah, you mentioned that earlier. It wasn't from actual business improvement.
No, not at all. It was a one-time accounting gain purely related to the changing value of their warrant liabilities on the balance sheet.
Okay, can you break down warrant liabilities for us? Why does that create a paper profit?
Sure. Warrants are basically long-term options to buy stock. Companies issue them, often alongside other financing. Accounting rules require companies to estimate the future liability associated with these warrants. If market conditions or assumptions change in a way that reduces that estimated future liability.
Like if the stock price goes down, making the warrants less likely to be exercised.
Or changes in volatility assumptions, things like that. Yeah. Then, paradoxically, that reduction in liability shows up as a non-cash gain on the income statement.
So it looks like profit, but no actual cash came in, and the business operations didn't improve.
Exactly. It's purely an accounting artifact. And while QUBT did disclose this in the footnotes, it definitely places a higher burden on management to communicate really clearly, especially to less sophisticated investors who might just see the headline profit and misunderstand.
Right. Avoids misinterpretation. Okay, capital allocation. How are they spending the money they raise?
Well, their strategy has been bold. That acquisition of QPhoton back in June 2022, that was really a bet the company kind of move. It pivoted them from more of a software consulting focus to a full stack hardware software firm.
A big shift.
Huge shift. And they've signaled that future M&A, mergers and acquisitions, will be a core part of their strategy going forward, especially now after that big $200 million private placement they completed in June 2025.
Right, they raised a lot of cash.
They did. They should have over $350 million in cash now. That's a massive war chest.
It creates opportunities for sure.
But also risks. Absolutely. The risk of poor integration if they buy something or just plain overpaying for acquisitions in a potentially frothy market, using that capital wisely is now a major test for management.
Okay. Share buybacks. Dividends. Pretty straightforward here, I imagine.
Yeah, exactly what you'd expect for a pre-revenue, high-growth, cash-burning company. They pay no dividend. They have no history of share buybacks.
Makes sense. They need the cash.
They need every penny. But here's the stark reality on the other side of that coin. Their primary funding method, how they get that cash, is by issuing new shares. Lots and lots of new shares.
Dilution.
Massive shareholder dilution. In the past year alone, the number of shares outstanding increased by a staggering 48.16%.
Wow. Nearly 50% more shares in 1 year. So if you held stock, your slice of the pie got significantly smaller.
Precisely. Your ownership percentage was heavily diluted. That's a major cost for existing shareholders.
How about return on invested capital, ROIC?
Well, as you might guess, it's deeply negative. The reported figure for fiscal year 2024 was negative 18.21%.
Meaning for every dollar invested, they lost about 18 cents.
In that period, yes. Now, negative ROIC is expected for a company at this stage, pouring money into R&D. The critical question isn't the past number, but whether the hundreds of millions in newly invested capital, including that recent $200 million raise, can eventually generate an ROIC that exceeds their cost of capital.
And their cost of capital must be pretty high, given the risk.
Exceptionally high. Given the extreme risks involved here, technological risk, market risk, execution risk, their weighted average cost of capital, WACC, is likely very, very high. Generating returns above that threshold would be a huge challenge.
So summarizing management's key skills so far,
Yeah.
what would you say it is?
Honestly, it seems to be less about operational execution because the revenue isn't there yet, and much more about financial engineering and narrative management.
Keeping the story alive,
Mm.
raising money.
Exactly. Their ability to raise over $350 million with negligible revenue is, frankly, quite remarkable. It speaks volumes about their ability to sell the vision. Right now, maintaining market confidence and ensuring continued access to capital is their immediate lifeblood. That's job number one.
Okay, that leads us perfectly into the numbers themselves. Chapter 3. Financial analysis. All right, Chapter 3. Financial analysis. Let's dig into these numbers.
Yeah.
Market cap first. As you said, QUBT is valued somewhere between $2.28 billion and $2.43 billion.
Yep, comfortably mid-cap territory by valuation.
Despite, as we discussed, operating like a very small micro-cap startup, that disconnect again.
It's the recurring theme.
Revenue growth trends. What do they look like?
Well, the revenue is minimal. Let's just be blunt. $136,000 in 2022, $358,000 in 2023, $373,000 in 2024. And the trailing 12 months TTM figure is around $385,000.
So under $500,000 annually.
Correct. Now, if you calculate percentage growth year over year, it looks high because you're starting from such a tiny base. Going from 100K to 300K is 200% growth.
Right. But the absolute numbers are still very small.
Exactly. The real story to watch, the number that needs to change dramatically, is the revenue ramp-up from that new foundry. That's expected later this year, late 2025, and into 2026. That's when we'll see if the picks and shovel strategy starts paying off.
Okay. Profit margins. I'm guessing this isn't pretty.
No, not pretty at all. The gross margin is actually positive, around 29.61%. That means the direct cost of what little they sell is less than the revenue they get for it. So that's something.
Okay, a small positive.
But then you factor in R&D, sales, general administrative costs, and the picture changes drastically. Operating margin is a staggering negative 7,247%.
Minus 7,000%.
Yes, and net margin is even worse, negative 11,720%. These numbers just highlight the massive, massive cash burn relative to the tiny revenue base.
Wow. Free cash flow generation. Following the same pattern.
Absolutely. Consistently and increasingly negative. It was negative $6.84 million in 2021. That grew to negative $22.99 million on a TTM basis.
Burning more cash each year.
Right. And this relentless cash burn is what drives the constant need for those equity offerings we talked about. They have to keep raising money to fill the hole.
Earnings consistency? Is that even the right word?
Maybe consistency of losses. Yes, they've reported significant net losses every single year. There was a sharp increase in the net loss reported in 2024, but remember...
That was the warrant accounting thing.
Exactly. That was mainly due to that large non-cash accounting charge related to warrant liabilities, not necessarily a worsening of the underlying business operations during that specific period, though the operations are still deeply unprofitable.
Okay. Financial stability. How does the balance sheet look, aside from the cash they just raised?
This is where the story gets interesting again, almost paradoxical. Regarding debt, their balance sheet looks like a fortress.
Really? Fortress?
Yeah, they have effectively zero debt. And this was true even before the recent $200 million raise, against over $220 million in shareholder equity previously, now much more. Post-raise, they have no debt.
Zero debt. That's impressive.
And their current ratio, which measures short-term assets against short-term liabilities, is an exceptional 17.36. That indicates very strong short-term liquidity. They have plenty of cash and liquid assets to cover immediate obligations.
But where did that strength come from?
It came entirely from issuing stock, from those equity raises. So the company itself isn't carrying financial risk in the form of debt, but that risk has essentially been transferred to shareholders through massive dilution. The balance sheet strength was bought with shareholder equity.
Got it. Okay, valuation analysis. This is where it gets wild, right? PE ratio is obviously useless.
Completely meaningless with consistent losses. You can't divide by zero or a negative number meaningfully here.
So we turn to price to sales, PS.
And QUBT is just an extreme outlier. Its TTM PS ratio, based on that 385K revenue and $2.03B market cap, is, wait for it, 6,177.
6,177.
Yes. To put that in perspective for listeners, the market is valuing every single dollar of QUBT's past 12 months of sales at over $6,000.
That's hard to wrap your head around. What do peers look like? IonQ, Rigetti.
Even other highly speculative quantum computing peers like IonQ, Rigetti, and D-Wave. Their PS ratios, while still very high compared to normal companies, are orders of magnitude lower than QUBT's. We're talking maybe in the dozens or low hundreds, not thousands. QUBT is in a league of its own on this metric.
Okay, so relative valuation says extreme outlier. What about intrinsic valuation? discounted cash flow, DCF. Can you even do one?
You can build a DCF model, but for a company like QUBT, it becomes less about finding a precise value and more about understanding the kind of assumptions you'd need to make to justify the current stock price. It's an exercise in reverse engineering the market's optimism.
What kind of assumptions are we talking?
Highly, highly aggressive assumptions. You'd need to plug in hypergrowth, maybe 100% or more annual revenue growth initially for several years, then maybe tapering to still very high growth, like 30–50% for many more years after that. And you'd have to assume they eventually achieve significant profitability and maintain strong margins.
Okay, heroic growth and profitability assumptions. What about the discount rate?
Crucially, to account for the extreme risk involved, the chance they fail completely, you'd need to use a very, very high discount rate. We're talking 30% to 40%, maybe even higher. That's typical for early-stage venture capital investing, not usually applied to public companies. It reflects the high probability of failure.
So super high growth, eventual profits, discounted back at a VC level rate. What value does that spit out?
Even baking in those incredibly aggressive best-case scenario type assumptions, an educational DCF model like that suggests an intrinsic value range of just $3 to $8 per share.
$3 to $8,
Okay.
compared to a current price around $14.73.
Exactly. That stark disparity really highlights how much the current stock price seems to be driven by narrative, sentiment, and speculation, rather than any plausible calculation of fundamental discounted future cash flows.
Wow. So summarizing the financials.
The financial statements basically present two completely different entities. On the income statement and cash flow statement, you see a tiny pre-revenue, heavily cash-burning startup.
Right.
But then you look at the balance sheet and you see a financial fortress with over $350 million in cash and zero debt.
Bought through dilution.
Bought entirely through massive stock issuance. And this creates what some people call a reflexive loop. The high stock price enables them to raise huge amounts of capital easily. That capital shores up the balance sheet, which provides a safety net and funds operations. And that strong balance sheet, in turn, helps support investor confidence and maintain the high stock price.
A self-feeding cycle.
It can be, yes, as long as the narrative holds and they can keep accessing capital markets. But if that narrative breaks, if confidence wavers, this reflexive loop can become a vicious cycle in the other direction very quickly. The stock price depends on the ability to raise money, which depends on the stock price. It's precarious.
Okay, that really sets the stage for the market dynamics. Let's transition now to part 2. Market dynamics and the road ahead.
Yeah.
Chapter 4, market sentiment. All right, chapter 4, market sentiment. How is the market actually viewing all this? Let's start with Wall Street analysts. What are they saying? Price targets.
Well, the analysts who cover it show some cautious optimism, generally leaning towards buy or hold ratings. The average one-year price target is somewhat modest, though. It's around $18.50 to $18.87, which is, maybe 25–30% upside from the current $14.73 price.
Not exactly shooting for the moon.
No. And the range of those targets is quite telling. It goes from a low of $14, which is actually below the current price, up to a high of $23.10.
So even the bulls aren't wildly bullish, and the low end suggests downside.
Precisely. And notably, Cantor Fitzgerald recently initiated coverage with a neutral rating and a $15 price target, pretty much right where the stock is trading. That suggests at least some analysts see it as fully valued right now, so definitely mixed signals from the professionals.
What about recent news impact? Media tone, social media buzz.
The general media tone is really polarized. You see extremes. On one side, you get the speculative hype articles throwing around comparisons like the NVIDIA of quantum photonics.
Wow, that's a bold claim.
Very bold, and probably premature, to say the least. Then on the other side, you get sober skepticism, focusing on the extreme valuation, the near-zero revenue, the high level of speculation involved.
Reality check pieces.
Exactly. Social media sentiment, interestingly, seems to be cooling off a bit from peak hype levels, according to some sources. But overall, it remains a high-risk, high-reward, moonshot narrative. And that narrative is what fuels the intense volatility we see in the stock.
Okay, now for a critical market indicator, I think, short interest. What does that look like?
This is one of the most telling indicators for QUBT. The short interest is exceptionally high. Depending on the source and calculation method, it's reported between 19.61% and 26.88% of the float.
So potentially over a quarter of the available shares are being shorted.
Yes. That translates to somewhere between 30 million and 34 million shares being held short. That is a massive bet against the company by a significant portion of the market.
What does that mean practically?
Well, it creates a very crowded trade. It means there's persistent selling pressure on the stock from those short sellers. But it also creates the potential for a powerful short squeeze.
Ah, the short squeeze. Explain that.
If some positive news comes out, maybe a big contract win or surprisingly good progress from the foundry, the stock price could jump up quickly. That forces short sellers to buy back shares to cover their positions and cut their losses. That buying pressure then pushes the price up even further, forcing more shorts to cover. It can create a rumpid, explosive upward move, often detached from fundamentals.
So the high short interest is both a sign of skepticism and a source of potential volatility fuel.
Exactly. It makes the stock a coiled spring, potentially.
How about the technical picture? Price relative to moving averages.
Technically, QUBT's current price of $14.73 is trading below its 50-day moving average, which sits around $16.36, $16.52. That's generally considered a bearish signal for the short-term trend.
Okay, short-term weakness. Long-term.
However, it's still trading well above its 200-day moving average, which is down around $9.63, $10.92. That typically indicates the longer-term uptrend is still intact, despite the recent pullback.
So conflicting signals there too.
Absolutely. Below the 50-day, above the 200-day, it signals a classic battlefield stock. Bulls and bears are fighting it out. The stock is deeply polarized, and it feels like it's priced for a dramatic move one way or the other.
Okay, let's look inside the ownership. Chapter 5. Ownership structure. Chapter 5. Ownership structure. Who actually owns QUBT? Institutional ownership. The big funds, pensions, endowments.
Institutional ownership is relatively low, actually, somewhere between 14% and 16% of the shares.
Low compared to more established companies.
Yes. It shows that many large conservative institutions are likely still wary, sitting on the sidelines, given the speculative nature and lack of fundamentals.
But what's the trend? Are they buying or selling?
The trend is positive, which is interesting. Recent filings show 146 institutions increasing their positions versus only 45 decreasing them. So money seems to be flowing in, net, from institutions.
Who are the top holders? Any notable names?
Top holders include the usual suspects like Vanguard and BlackRock, mostly through index funds. But perhaps more significantly, some active managers, well-known firms like Morgan Stanley and Tudor Investment Corp have established new positions recently.
Tudor, the macro hedge fund.
Yeah.
Interesting.
Plus, remember that $200 million private placement? That went to what were described as preeminent global investment firms. We don't know exactly who they are yet, but it suggests some sophisticated, smart money is definitely buying into the story, likely with a long-term view.
Okay, so institutional interest is growing, albeit from a low base, and some smart money seems to be involved now. What about insiders, management, founders?
Insider ownership is quite high, around 19.4%. That typically is seen as a positive, aligning the interests of management with shareholders.
Who's the biggest insider holder?
The interim CEO, Dr. Yuping Huang, holds over 21 million shares. Based on the current price, that's worth well over $300 million. So he has significant skin in the game.
Okay, that sounds good.
But this high ownership is significantly overshadowed, in my opinion, by a recent pattern of heavy insider selling.
Selling, not buying.
Selling. In the last 6 months, insiders collectively sold 1.2 million shares on the open market. And during that same period, there were 0 open market purchases by insiders.
Wow. All sell, no buy. Who is selling?
The selling came from various insiders, including the chief financial officer and several directors. This kind of consistent one-way flow insiders cashing out shares, especially after a significant run-up in price, is generally considered a significant red flag for investors.
Why is it a red flag? They could have many reasons to sell.
They could, absolutely. People sell for diversification, taxes, buying a house. But when you see multiple insiders selling significant amounts and nobody's buying, it raises questions about their confidence in the stock's future prospects at the current valuation. They have the most information, after all.
Okay, that's definitely something to watch. Ownership concentration. Is it tightly held?
It's fairly concentrated at the top. Insiders and institutions together own about 1/3 of the company, and Dr. Huang, with his large stake, has outsized influence.
But that leaves...
That leaves the vast majority, roughly 85% of the ownership, held by the public and retail investors.
85% retail. That's very high.
Extremely high. And this high retail ownership is a major factor fueling the stock's volatility and its susceptibility to narrative-driven trading, social media sentiment, and that meme stock phenomenon we mentioned.
So, putting it all together, what does this ownership picture suggest?
To me, it suggests a kind of changing of the guard dynamic might be happening.
Changing of the guard.
Yeah. The initial meteoric rise in the stock price was likely fueled heavily by retail enthusiasm and momentum trading. Now, as the company perhaps gains a bit more legitimacy through building the foundry, getting that big institutional private placement, you're seeing more sophisticated, longer-term investors starting to enter.
Okay.
But at the same time, it looks like some insiders are using the liquidity provided by this increased interest and higher price to de-risk their personal holdings and cash out significant portions.
So, insiders selling into strength.
It appears that way. It's a classic pattern you often see during market hype cycles. Essentially, it can be viewed as a transfer of risk from the early insiders who got in cheap to the new wave of investors, both institutional and retail, buying in at much higher valuations. Whether that transfer proves wise for the buyers remains to be seen.
Okay, that's a crucial dynamic. Let's formally assess the risk now.
Yeah.
Chapter 6, risk assessment. All right, Chapter 6, risk assessment. Let's structure this with a SWOT analysis. Strengths, weaknesses, opportunities, threats. Starting with strengths, what are QUBT's core strengths?
Okay, strengths. First, definitely their differentiated photonic technology, specifically the potential of that room temperature operation. That's a core R&D strength.
Right.
Second, the vertically integrated TFLN photonic chip foundry. That gives them potential supply chain control and, importantly, that separate, tangible revenue stream opportunity.
The hedge.
The hedge, exactly. Third, that fortress balance sheet we discussed, over $350 million in cash, no debt. That gives them a multi-year operational runway, which is critical.
Buys them time.
Buys them significant time.
Yeah.
And fourth, you'd have to include the leadership under Dr. Huang. Having a deep technical expert and founder at the helm is a strength for a company like this.
Okay, those are the positives. Now, weaknesses, what are the big ones?
The weaknesses are pretty stark, frankly. First and foremost, the negligible financial track record. Virtually no revenue, deep losses, massive cash burn.
The numbers we just went through.
Exactly. Second, the massive and ongoing shareholder dilution required to fund the company. That near 50% increase in shares outstanding last year is a major weakness for existing shareholders.
Definitely.
Third, the valuation. It seems completely disconnected from current fundamentals. That 6,000 PS ratio is a huge vulnerability if sentiment shifts.
The elephant in the room.
It really is. And fourth, that pattern of significant recent insider selling we just discussed, that has to be listed as a weakness, or at least a major concern.
Okay. Opportunities, where's the potential upside?
The opportunities are definitely compelling, which is why the stock commands the valuation it does. First, the sheer size of the potential markets they're targeting. Quantum computing and photonic integrated circuits are both projected to be massive, multi-billion-dollar markets with high growth rates.
Huge total addressable markets, TAM.
Huge TAM. Second, the growing government and defense spending tailwind for quantum technologies globally. That provides funding opportunities and potential customer demand.
Right, government contracts.
And third, the potential for strategic M&A. With their huge cash hoard, they could be a buyer, acquiring complementary tech or teams. Or, arguably, they could themselves become an attractive acquisition target for a larger tech giant looking to quickly enter the quantum photonics space.
Interesting. Acquire or be acquired. Okay, finally, threats. What are the biggest external risks?
The threats are formidable. Number one is just the intense competition. We talked about the deep-pocketed tech giants like Google and IBM, plus the well-funded pure-play quantum startups and the established photonics players. It's a Shark Tank.
Very competitive.
Number two is execution risk and technological risk.
Yeah.
Can they actually scale up the foundry successfully? Can they manufacture reliably and affordably? Can they commercialize their quantum products effectively? These are huge unknowns.
Big hurdles to clear.
Absolutely. And related to that is the fundamental industry challenge, achieving fault-tolerant quantum computation. If the whole field struggles to overcome the NISQ era limitations, it could lead to a quantum winter.
A quantum winter.
Like the AI winter. Exactly. A period where progress stalls, hype dies down, and funding dries up across the board. That would be a major threat to a company like QUBT that relies on external capital.
Okay.
Other threats?
Geopolitical risks. We mentioned export controls and tariffs potentially impacting their supply chain and costs for critical components like lithium niobate.
Right. And broader economic factors.
Yes, macroeconomic factors are definitely a threat too. High interest rates are particularly bad for long-duration, speculative assets like QUBT.
Why is that?
Because higher interest rates increase the discount rate used in valuation models like the DCF. When you discount potential future earnings further out in time at a higher rate, their present value today becomes much, much lower.
Yeah.
It directly compresses the theoretical value of companies banking on future profits.
Makes sense. And inflation.
Inflation also hurts by increasing their operating costs, salaries, materials, energy, which exacerbates their already significant cash burn.
Yeah.
So the current macro environment is generally hostile to companies like this.
I'm digging into those geopolitical factors a bit more. Tariffs. Yeah, specifically, if the U.S. were to impose significant tariffs on critical inputs they might need for their foundry, say, the raw lithium niobate material, or specialized optical components sourced from certain regions that could inflict crippling costs, according to the research.
Crippling costs.
Yeah, it could create procurement bottlenecks, delay manufacturing and R&D timelines, and directly undermine that core, affordable value proposition they're aiming for. It's a very real risk given current global trade tensions.
Okay, we've covered a tremendous amount. Let's try to bring it all together. Chapter 7, conclusion. All right, Chapter 7, conclusion, synthesizing everything we've discussed. Let's start with the bull case. If you're optimistic about QUBT, what's the core argument?
The bull case, I think, really rests on four main pillars. First, their differentiated technology, that room temperature photonics approach. If it proves scalable and effective, it's a potential game changer.
Pillar 1, tech differentiation.
Second, the strategic value of the in-house TFLN foundry. It's not just a hedge, it's a real business opportunity in the growing PICs market, providing potential revenue and supply chain control.
Pillar 2, the foundry hedge.
Third, the fortress balance sheet. Over $350 million in cash, no debt. That provides a crucial multi-year runway to actually execute on their plans. It de-risks the immediate financial future.
Pillar 3, financial runway.
And fourth, the leadership. Visionary, technically proficient leadership under Dr. Huang, the original founder of their core technology. You're betting on him and his team to deliver.
Pillar 4, leadership. Okay, that's the bull case. Now the bear case. Why would you be pessimistic or cautious?
The bear case is equally, if not more, compelling from a traditional investment standpoint. It also has several key points. First, the valuation is just astronomical, dangerously overvalued.
The 6,000 PS ratio.
Exactly. A $2+ billion valuation on less than $500,000 in annual revenue and deep, consistent losses. Many would argue that's simply unsustainable, regardless of the potential.
Bear point 1, extreme valuation.
Second, the continuous, massive shareholder dilution. Your ownership stake is constantly shrinking as they issue more shares to fund operations. That's a significant headwind for shareholder returns.
Bear point 2, dilution.
Third, that troubling pattern of recent insider selling. Insiders cashing out millions while retail and new institutions buy in.
Well,
That's often a bearish signal.
Bear point 3, insider selling.
And fourth, just the massive uncertainty and risk around execution and commercialization. They have yet to prove they can scale the foundry, generate significant revenue, or successfully commercialize their quantum products against intense competition. There's a high chance they fail to deliver on the lofty promises.
Bear point 4, unproven execution and high risk.
Exactly. It's a powerful counterargument focused on fundamentals and risk.
Okay, so let's bring back that intrinsic value estimate. Remind us what the speculative DCF suggested.
Right. Based on that educational discounted cash flow model, which tried to incorporate the high growth needed and the extreme risk through a high discount rate, the estimated intrinsic value range for Quantum Computing Inc. came out somewhere between $3 and $8 per share.
$3 to $8.
A very wide range, reflecting the uncertainty, but significantly below the current market price.
So the concluding outlook.
Yeah.
As of today, July 30, 2025, with the stock at $14.73.
Therefore, as of today, QUBT's share price of $14.73 trades at a very significant premium to our estimated intrinsic value range.
Okay.
From a fundamental value investing perspective, the stock appears highly overvalued. The current market price seems sustained almost entirely by a powerful narrative, intense speculative interest, and essentially hope for a low probability but extremely high payout outcome hitting the quantum jackpot, so to speak.
So an investment today.
An investment in QUBT at this price is really not a bet on its current business or fundamentals. It's a speculative bet. A bet that this company will defy the odds and become one of the few dominant winners in a potentially transformative but still highly uncertain future industry. It's much closer to venture capital than traditional stock investing.
Wow. Okay, that really crystallizes the situation. As you ponder QUBT, maybe ask yourself this. In this race for quantum supremacy, which carries more weight for you as an investor, A concrete, potentially profitable picks and shovels business like the foundry, or the grand promise of a future technological revolution?
The tangible versus the aspirational. It's a key question here.
We hope this deep dive into quantum computing, Inc. has given you a valuable shortcut to being well-informed on this complex company. If you found these insights useful, please do subscribe, like, and leave us a review wherever you get your deep dives. It genuinely helps us reach more curious learners like you.
Your support makes a difference.
And remember, for priority deep dives on specific tickers you're interested in, or for exclusive access to analysis covering all of the S&P 500 stocks over the next few months, yes, all 500 like and subscribe to the Stock Analytics AI YouTube channel. Members get priority access and can suggest stocks.
Great resource.
And if you want a one-off deep dive on a particular stock, just drop them a super thanks on their channel. And don't forget, they will be covering QUBT's upcoming earnings within minutes of release, so stay tuned to the Stock Analytics AI channel for that immediate analysis.
Definitely keep an eye out for that earnings report. It could be market moving.
Absolutely.
And finally, just the standard but important reminder. This analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice.
Please do your own research.
Yes, please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.